Hello. Today we are going to cover the next topic of corporate governance, which is the corporate governance mechanism. Let us start the discussion with the key roles and responsibilities of the board. The board of directors acts as the ultimate governing body of a company. As a legal entity, a company cannot act on its own. So the board is responsible for providing leadership, setting strategy, and supervising the management. The board is tasked with ensuring the company's long-term sustainable success and maintaining trust with shareholders and stakeholders. Key responsibilities include promoting the company's purpose, values, and strategy, providing guidance and ensuring resources are in place to meet objectives, establishing a framework for risk assessment and management, ensuring accountability to all stakeholders, demonstrating ethical leadership, implementing a corporate disclosure policy to ensure transparency. Now let us look at formation and size of the board. The document explains that the directors are collectively known as the board of directors, and the text which you have available on your hand, if you look into it, you will find out that it outlines specific legal requirements for board size, which vary depending on the company type and jurisdiction. Specifically, we can consider Bangladesh as an example in this case as well. If we look at the Companies Act of 1994, we find out that a public limited company must have at least 3 directors, with a private limited company needs at least 2. A one-person company has 1 director. Now, Bangladesh Securities and Exchange Commission, or BSEC, Corporate Governance Code, it indicates that for a listed public company, the board must have a minimum of 5 and a maximum of 20 members. Additionally, at least 1/5 of the total directors must be independent. 1/5 means 20%. Banking Company Act of the country indicates that the board should not exceed 20 directors, including at least 3 independent directors. If the total is less than 20, then there must be at least 2 independent directors. Now let us look at different types of boards. There are basically 2 types of boards, unitary and dual board. Let us start with the unitary board. This single board combines both executive, non-executive, and independent directors. All directors are collectively responsible for all company activities. The structure is common in the UK and also in Bangladesh. Dual board. This system consists of a separate supervisory board and an executive board. The supervisory board provides oversight while the executive board handles day-to-day management. Members of one board cannot be on the other. The structure is prevalent in countries like Germany and Austria. Now, structure of board of directors. A board should have a mix of directors to ensure effectiveness. So, there are 3 different types of directors, broadly, if we look into it. The first one is the executive director, a full-time employee with senior management responsibilities, and this executive director provides operational expertise and manages the day-to-day affairs of the company. A non-executive director, on the contrary, is a board member without daily management responsibilities. Their role is to provide independent oversight, strategic advice, and monitor management performance. They play a key part in setting executive remuneration and managing risks. A list of areas where the non-executive directors can effectively contribute include formulation of strategy in line with the vision and mission of the company, monitoring performance of the company, remuneration of the executives, communication, risk management, and internal audit and compliance. Then comes independent director. A specific type of non-executive directors are the independent directors. An independent director is free from any relationships that could compromise their judgment. They bring an objective view to board discussion, safeguard the interests of all shareholders, particularly the minority shareholders, and have specific duties and functions outlined by the Corporate Governance Code. Let us look at the roles and functions of the independent director. Independent directors serve as a critical component of a company's board, providing an objective and impartial viewpoint. The main role is to balance the often conflicting interests of various stakeholders, acting as a check on the power of the owners and management. They contribute to succession planning and serve as a sounding board or mentor for their full-time executive colleagues. Their core functions revolve around oversight and governance. They include bringing independent judgment to board discussion, particularly on issues of strategy, performance, and risk management. Objectively evaluate the performance of the board and management, safeguard the interests of all stakeholders, especially the minority shareholders, ensure the integrity of financial information, and confirm that the financial controls and risk management systems are robust, play a prime role in determining executive remuneration and in the appointment or removal of key managerial personnel. They also act as an arbitrator or arbitrators in conflicts between management and shareholders. To fulfill these roles, independent directors have specific duties. They must stay informed and knowledgeable about the company, actively participate in board and committee meetings, and ensure their concerns are formally recorded in meeting minutes if not resolved. They're also responsible for upholding ethical standards, ensuring a vigil mechanism is in place for reporting concerns, and maintaining the confidentiality of company information. Now let us look at the duties of independent director. Independent directors have a specific set of duties to ensure they remain knowledgeable, active, and ethical in their role. These duties include, number one, stay informed and engaged. Means they must regularly update their skills and remain knowledgeable about the company and its external environment within which it operates. This includes attending all board and committee meetings and actively participating in them. Seeking clarification and professional advice. Independent directors have the right to seek clarification on information and obtain professional advice from outside experts at the company's expense whenever necessary. Ensuring accountability. They must ensure that the company has a functional vigil mechanism where, for example, it's a whistleblower system, and that the interests of those who use it are protected. They also have a duty to report concerns about unethical behavior or fraud. Protecting stakeholders. One of the key duties of the independent directors is to act in the legitimate interest of the company, its shareholders, and employees. They must scrutinize related party transactions to ensure they are fair and are not determined or detrimental to the company. Maintaining confidentiality. They're obliged not to disclose confidential information, such as commercial secrets or, let's say, unpublished price-sensitive information, unless specifically approved by the board or required by the law. The Bangladesh Securities and Exchange Commission or BSEC Corporate Governance Code for 2018 sets out specific requirements for independent directors, ensuring they are truly impartial and qualified to serve on a company's board. Now let us look at some major regulatory provisions regarding independent directors in Corporate Governance Code 2018. First of all, we will look into the key requirements for independent directors. First of all, proportion of directors. At least 1/5 or 20% of a company's total number of directors must be independent directors. Any fractional result is rounded up to the next whole number. Then the definition of independence. The code strictly defines an independent director as someone who is free from any relationship with the company or its major stakeholders that could interfere with their independent judgment. Then shareholding. An independent director can hold no shares or less than 1% of the company's total paid-up shares. Then comes no conflict of interest. An independent director cannot be a sponsor of the company. They also cannot have any close relationship as being a family member of the sponsor, director, or shareholders who holds 1% or more of the company's shares. That means they cannot be family members of anyone who has 1% or more of the ownership of the company's shares. So this is crucial. They also cannot have an executive of the company within last 2 years or have any other significant financial or non-pecuniary relationship with the company, its subsidiaries or associated companies. Professional independence. An independent director cannot be a partner or executive of the company's statutory audit firm, internal audit firm, or any professional firm that certifies compliance with the code for the preceding 3 years. And other restrictions. They must not serve as an independent director on more than 5 listed companies at a time. They also cannot have been convicted of a criminal offense involving moral turpitude or for defaulting on a loan from a bank or in BFI. Appointment and tenure. Independent directors are appointed by the board of directors and must be approved by the company's shareholders at the AGM or annual general meeting. If an independent director's position becomes vacant, it must be filled within 90 days. 3 months, 90 days. The term of independent directors is 3 years, with the responsibility of being extended for 1 additional tenure. After completing 2 consecutive terms or 6 years, they cannot be appointed for another 3 years. They are not subject to retirement by rotation as stipulated by the Companies Act 1994. The BSEC outlines that an independent director must be a knowledgeable individual with a strong sense of integrity who can make meaningful contributions to the business. Now, question arises about who can be an independent director. Several professional and academic backgrounds can supply a large number of independent directors. In other words, independent directors can come from a mix of professional and academic backgrounds. This include business or corporate leadership, government service, academia, and professional expertise. Now let us look into business or corporate leadership first. Individuals who have served as promoters or directors of unlisted companies with a minimum paid-up capital of 100 million or top-level executive of listed or unlisted companies, as for example CEO, CFO, company secretary, etc. When we look at, let's say, the government service, former government officials at a rank not lower than the 5th grade of the national pay scale can also be appointed as an independent director with a bachelor's degree in a relevant field, of course, like economics, commerce, business, or law. Then comes academia, a university teacher with a background in economics, commerce, business studies, or law. Then professional expertise, a professional such as advocate practicing in the High Court, a chartered accountant, cost and management accountants, or other relevant certified professionals. Additionally, to be appointed, an independent director must have at least 10 years of experience in any one of the fields which I have just discussed. In special circumstances, of course, these qualifications and experience requirements can be relaxed, but of course with prior approval from the Commission. Let us now discuss about shadow director. A shadow director is an individual who is not formally appointed to a company's board but whose instructions and directions are routinely followed by the company's officially appointed directors. This individual or individuals can be held legally accountable for the company's actions just like a de jure or officially appointed or de facto acting as a director. The concept borrowed from English law is designed to ensure that a person who controls a company's activities from behind the scene cannot escape liability. A person is not considered a shadow director if they are, or he or she or they are, let's say, merely giving some professional services. such as the lawyers or accountants. Now let us discuss about nominee director or nominee directors. A nominee director or nominee directors is a type of non-executive director appointed to represent the interests of a specific party, such as a large shareholder or creditor. Under the Companies Act 1994, a company that is a member of another can authorize an individual to act as its representative at meetings. This person is entitled to the same powers as an individual shareholder. Nominee directors are not considered independent. Remember, they are not considered independent. And their numbers are excluded when calculating the number of independent directors required on a board. Then comes alternate directors. An alternate director can be appointed to act for an original director during their continuous absence from the country for a period of at least 3 months, as per the Companies Act 1994. The alternate director's tenure is limited to the original director's absence, and they must vacate the office once the original director returns. An alternate director, on the other hand, is appointed to fill a casual vacancy on the board, and the term is tied to the remainder of the original director's term. Diversity on a company's board of directors is increasingly recognized as a vital component of good corporate governance. This is because a board with diverse perspectives, including those of women, is better required to make effective decisions and deliver sustainable value to its shareholders. So now we are going to discuss about women representation on the board. Women representation brings diversity and it improves governance. You see, boards with varied perspectives foster collaboration and stronger decision-making is obviously an outcome of it. Referring to someone as a women director is unnecessary and discriminatory, of course. Directors should be defined by their roles, executive, non-executive, or independent, not gender. Then let us look at the need for gender diversity, you see. Despite the progress in education and employment, women remain underrepresented in leadership and decision-making positions. Is there any business benefit for having women representation on board? The answer is, of course, yes. Including qualified women on boards helps companies to tap into underutilized talent, better understand stakeholders, and gain competitive advantage through diverse thinking. Then let us look at the legal, or let's say regulatory framework. The Companies Act of Bangladesh requires directors to be natural person without gender distinctions. Additionally, the Bangladesh Securities and Exchange Commission, or BSEC 2018 Corporate Governance Code, requires listed companies to have board diversity policies considering factors such as gender, age, experience, and background. In short, the gender diversity on board is essential for sustainable corporate growth, stronger governance, and competitive advantage, and is now formally recognized in Bangladesh's government regulations, or governance regulations to be particular. So definitely we must look into it very seriously. Now, what are the benefits of having women on the board? First of all, improved financial performance. There is a positive correlation between women's participation in decision making and a company's financial performance. Because try to understand, a broad segment of your consumers often constitute women. So if they're not represented in the leadership, then obviously it will be very difficult for the organization to understand the mindset and point of views of a broad segment of the overall consumer group. Then better decision making. Gender balanced boards bring a wider range of perspectives, leading to more thorough due diligence and better informed decision. Enhanced corporate governance. Boards with female members are more likely to focus on non-financial matrices like customer satisfaction and corporate social responsibility, and that tend to have better oversight and accountability. Cultivating talent. The presence of women in leadership roles help reinforce a company's culture of diversity and inclusion, making it easier to attract and retain top talent. Now, let us look at the barriers to women's leadership. Despite the recognized benefits, women continue to be underrepresented in leadership roles due to several barriers. The first one is structural barriers. The second one is institutional mindset. The third one is individual mindset, and of course, lifestyle choices. Let us look into them one by one. Structural barriers. These include glass ceilings and glass walls, where women are often clustered in specific management functions like HR or communication, rather than in the roles that provide the broad experience needed for top-level positions like operations and finance. Then comes institutional mindsets. Gender bias and stereotypes, which often associate leadership traits with traditionally masculine characteristics, create a conflict for women who are expected to embody both leader and women traits. Then comes individual mindsets. Some women may self-select out of pursued top positions due to socialization pressure, lack of confidence, risk aversion, or a desire to prioritize work-life balance. Lifestyle choices. The societal expectation is that women have to often, bear the primary responsibilities for both being a breadwinner and caregiver. And it can, sometimes create a significant barrier to career advancement. Now the question is, how can we deal with the debate? Quotas or voluntary targets? To address the underrepresentation of women, there is an ongoing debate about whether to use mandatory quotas or voluntary targets. Let us look into the arguments for both. Supporters for quotas argue that quotas are necessary to quickly increase diversity and create a critical mass of female leaders who can serve as mentors and role models. On the other hand, the people who argues against quotas in favor of voluntary targets, they say that the quotas are demeaning to the women, suggesting that they cannot achieve leadership positions on their own merits. They argue that quotas not lead to a tokenistic perception, undermining the credibility of women appointed to boards. The alternative approach is to focus on equality of opportunity rather than mandated results. This involves companies creating an environment where both men and women have equal access to career development and leadership opportunities. Now let us look at the powers and duties of directors. First of all, the powers of directors. The board of directors manages the company and can exercise all powers not reserved for the general meeting under the Companies Act 1994. The key powers include managing company businesses and expenses, appointing and managing director or manager with appropriate remuneration, borrowing funds within limits and issuing securities, making calls on shareholders, investing company funds, granting loans or guarantees, approving financial statements and board reports, diversifying, merging, reconstructing, or acquiring companies, appointing, removing key managerial persons or KMPs, internal and secretarial auditors. Now let us look at the duties of directors. First of all, fiduciary duties. It includes the duties of the directors related to act honestly and in the best interest of the company, to avoid conflicts of interest and secret profits, and the duties which are owed to the company as a whole, not individual shareholders. Now, care, skill, and diligence. Directors must exercise reasonable care and competence expected of their knowledge and status. The standards depend on the nature of business, role, and circumstances. Then comes board participation. Directors must attend the board or committee meetings and fulfill shareholder mandatory responsibilities. Then let us look at the non-delegation and disclosure. Directors cannot delegate duties beyond what the Act or company constitution allows. They must disclose the conflict of interests. Then comes good faith obligations. Directors must promote company objectives in the best interest of members, employees, shareholders, community, and the environment as a whole. Then comes prohibition of undue gain. Directors must not benefit personally or for associates. If so, they must return gains to the company. Then comes compliance. Directors must maintain statutory records such as mortgages, registers of directors, member lists, resolutions, etc. They must file reports with the registrar as required. Then comes restrictions. Directors cannot assign their office, void if attempted. The directors must ensure that accurate minutes of meetings, resolutions, and attendance are recorded. Now let us look at the proceedings of directors. Obviously, a brief of the proceedings. And for that, we need to basically look at the summary of Regulations 88 up to 95 of Schedule 1 of the Companies Act 1994. And this particular piece of document indicates that directors regulate meetings with majority voting and chairman's casting vote in ties. Minimum quorum is 3 when directors exceed 3. Directors may act despite vacancies until quorum is restored. Chairman of board or committees is elected by members. Powers can be delegated to committees which follow board-imposed rule. Committee decisions follow majority voting, with chairman's casting vote if needed. Actions remain valid even if later found that appointments were defective. In short, directors hold wide powers to manage, invest, and of course expand the company, but they are bound by strict duties of loyalty, care, good faith, and compliance. Their proceedings are governed by clear rules ensuring accountability, quorum, delegation, and validity of decisions. Now let us look at a summarized version of directors' evaluation. Now, why is it important and what is the purpose of it? Directors' evaluation is a vital tool for strengthening the corporate governance and, of course, enhancing organizational performance. It helps boards identify weaknesses, maximize strengths, and adapt to dynamic business environments. Scope of evaluation. Evaluations assess the role and responsibilities of the board and its member, measuring their effectiveness both individually and, of course, collectively. And stakeholders and investors expect boards to function effectively, making evaluation a way to assure accountability. Now, what are the benefits of it? You see, it improves performance at 3 levels: organizational level, board level, and individual membership level or individual member level. It enhances leadership, teamwork, accountability, decision-making, communication, and efficiency. It encourages continuous improvement and better use of directors' skill. It strengthens board culture, group dynamics, and broad management relations. It identifies skill gaps and encourages directors' active participation in meetings. Annual assessment. Regular evaluations act as a change agent, transforming good boards into great boards by fostering collective action, cohesiveness, and adaptability. If we look at the purpose of directors' evaluation, we will see the purposes include: number 1, improve board performance towards corporate goal. Number 2, assess balance of skill, knowledge, and experience. Number 3, identify concerns and focus areas for improvement. Number 4, clarify roles of directors individually and collectively. Number 5, build teamwork among board members. Number 6, strengthen coordination between board and management. And number 7, contribute to overall organizational growth. In summary, directors' evaluation enhances governance by systematically reviewing performance, identifying gaps if there is any, strengthening teamwork, and driving continuous improvement at all levels of the organization. Now let us look at the maintenance of books of accounts and audit. Maintenance of books of accounts. First of all, the record-keeping requirements. Directors must maintain proper books covering receipts and expenditures, sales and purchases, assets and liabilities, and cost accounts, obviously whenever relevant. Then location and access. Books must be kept at the registered office or another approved location and be open to inspection by the directors. Members can only inspect if permitted by law, the board, or a general meeting. Financial statements. Directors must prepare profit and loss accounts, balance sheets, and reports are required under the Companies Act 1994. These must present true income, expenditure, and reasons for deferred expenses. Balance sheets and reports. These must be prepared annually, no later than 6 months before the AGM or Annual General Meeting, accompanied by directors' reports on company affairs, proposed dividends, and reserve funds. Copies must be sent to the eligible members at least 14 days before the meeting. Legal compliance. Directors must comply with all provisions of sections 181 up to 191 of the Companies Act 1994 in Bangladesh. Now let us look at the audit process. Appointment and regulation. Auditors are appointed by the board and approved by shareholders with duties regulated by law. And these are stated in sections 212 and 213 of the Companies Act 1994. Listed companies. Public companies listed on stock exchanges must appoint external or statutory auditors, ensuring independence. Prohibited services by the auditors to avoid conflict of interest. An auditor cannot be involved in appraising the firm or determining the valuation of the firm because it may actually affect the fairness of decision. Prohibited services by auditors to avoid conflict of interest. Number 1, appraisal, valuation, fairness opinion. Number 2, financial system design or implementation. Number 3, bookkeeping and accounting record services. Number 4, broker-dealer or actuarial services. Number 5, internal or spatial audits. Number 6, governance compliance, certification. Number 7, any other conflicting services determined by the audit committee. Restrictions on auditor shareholding. External auditors and their family members, like spouse, children, parents, siblings, in-laws, cannot hold shares in the audited company during the audit period. Accountability to shareholders. External auditors must attend shareholder meetings like the AGM or EGM to answer shareholder queries. In short, directors must ensure accurate, transparent, and legally compliant financial records and statements. Independent auditors, free from conflicts of interest, provide external oversight, ensuring accountability to shareholders and strengthening the governance. Let us now look at directors' training, development, and familiarization. The first one is directors' training. Training is essential for board effectiveness, cohesion, and governance. Training includes both induction for new members and ongoing development for all directors. Training ensures directors gain the necessary knowledge and skills distinct from management, improving board performance. Compliance with training can be used as a measure for reappointment. Training policies should specify the focus, the type, and availability of education. Now let us look at directors' induction. Induction aims to help new directors quickly participate in decision-making and build rapport with the peers. Now, what are the methods? You see, like briefing papers, internal visits, introductions, etc. can be different ways of induction. Key areas of understanding. Company's financial, strategic, operational, and risk position. For understanding them, you see, like it is very important that the directors are inducted properly. The induction indicates about the duties and the responsibilities of the directors more clearly. Through induction, directors will be able to understand the roles of senior executives and board committees. The induction kit may include the constitution documents, the company history, business plan, policies, etc., protocols for meetings and events, press releases, reports, menus of past meetings, etc., schedules of board or committee meetings, and also board procedures. Directors' development. Directors' development goes beyond training. It is a structured professional advancement. It ensures directors stay updated with governance, technology, markets, and industry changes. Methods include ongoing education on laws and regulations, site visits to projects for practical insights, seminars on regulatory compliances, short and long-term courses, both domestic and abroad. Familiarization program. Familiarization program especially is important for independent director. It helps them to understand the company's industry and the business model as a whole, the roles, rights, and responsibilities of independent directors, and the regulatory environment and the peer benchmarking. In short, training, induction, development, and familiarization programs ensure directors are well prepared, continuously updated, and capable of contributing effectively to the governance, decision-making, and long-term company success. Now let us look at the effectiveness of the board of directors. Board effectiveness depends on leadership skills, knowledge, and commitment of individual directors. Effectiveness requires a balanced, diverse, and appropriately sized board with expertise in finance, law, and management. The board must continually analyze and evaluate its performance. Responsibilities and authorities of the board. Vision, mission, and strategic planning. You see, like setting objectives and annual work plans aligned with vision and mission is extremely important for effectiveness of the board. Monitoring progress quarterly and report to the shareholders are also essential. Setting KPIs for CEOs and top management are, of course, priorities. There is no doubt about it. Now let us look at the risk management dimension. Identifying, assessing, and mitigating risks affecting the financial statements are obviously important for effective boards. Then establishing risk policies and monitoring compliance are also essential. In terms of internal control, ensuring independent internal audit processes, monitoring and maintaining effective control to prevent fraud, errors, and non-compliance are obviously the essential tasks. If we look at the human resource management dimension, then we can say that approval of HR policies for recruitment, promotion, discipline, and development are essential for effective boards. Then promoting skill development, MIS adoption, and ethical conducts are obviously, undoubtedly important. Financial management. Approval of annual budget, financial statements, procurement policies, and capital expenditure are, of course, among the major responsibilities, major tasks that must be fulfilled to ensure that board is running effectively. Now, what are the key positions of a board? The first one is chairman of the board. The chairman of the board leads the board, manages meetings, ensures full participation, sets agenda, promotes integrity and governance culture across the organization. The chairman oversees director introduction, development, induction, and performance evaluation. Chairman ensures effective communication with shareholders. Performance evaluation by all board members based on leadership, communication, decision-making, and integrity are also, you see, some of the important tasks of the chairman of the board. Then comes managing director or CEO. CEOs manage day-to-day operations, execute board strategies, communicate between board and management. They're responsible for achieving financial or business goals. Managing directors or CEOs. CEOs manage day-to-day operations, execute board strategies, communicate between board and management. They are responsible for achieving financial or business targets, strategic planning, and stakeholder relationships. Performance evaluated by the board, potentially with external facilitation. Then comes company secretary. Company secretary acts as the chief administrative officer, provides governance guidance, compliance oversight, and liaison with regulators and shareholders. They ensure proper board procedures, high-quality information, director induction, and ongoing board evaluation. Appointments and tenures. MDs or CEOs, CFOs, HISC, and company secretaries must be appointed, must be separate individuals, of course. Appointments must comply with Companies Act 1994 and Corporate Governance Code of 2018. Tenure of MDs or CEOs is up to 5 years, renewable with shareholders' approval. Separation of chairman and CEO roles ensures checks and balances are in place. It reduces conflicts of interest, improves governance, accountability, and strategic focus. Benefits include better directed communication, guidance for CEO performance, focus on shareholder interests, stronger regulatory compliance, long-term strategic planning, and of course, succession planning. Meeting of the Board of Directors. A company as an artificial legal entity operates through a board of directors elected by its shareholders. The Companies Act of 1994 mandates that every company must hold at least 4 board meetings annually. 4 board meetings annually, ensuring that no more than 90 days, once again, no more than 90 days elapse between 2 consecutive meetings. The Bangladesh Securities and Exchange Commission or BSEC's Corporate Governance Code of 2018 further stipulates that the companies must conduct board meetings and maintain records in accordance with the relevant Bangladesh Secretarial Standard or BSS as adopted by the Institute of Chartered Secretaries of Bangladesh or ICSB. For one-person companies or OPCs, the Companies Second Amendment Act of 2020 requires at least 1 board meeting per 6 months. Once again, OPCs or one-person companies require at least 1 board meeting every 6 months. Attendance requirements for key personnel. According to the condition number 3.2, subsection 2 of the Corporate Governance Code of 2018, the Managing Director of Chief Executive Officer, the Managing Director once again, or Chief Executive Officer, MD or CEO, Company Secretary, Chief Financial Officer, Head of Internal Audit and Compliance are required to attend board meetings. However, the Company Secretary, CFO, or the Head of Internal Audit and Compliance should not attend parts of meeting that involve discussions of their personal matters. Let us look into the ethics and compliance in conformity with National Integrity Strategy or NIS. The government of Bangladesh introduced the NIS or National Integrity Strategy in October 2012 to promote good governance, prevent corruption, and enhance national integrity across various sectors, including both state and non-state institutions. The NIS aims to establish a system of governance that fosters public trust and encourages societal participation in upholding integrity. Core goals and principles. The NIS seeks to ensure that individuals with integrity hold positions of responsibility, promote competent and non-partisan public service, enhance financial accountability, strengthen the independence of the judiciary, and empower institutions like the Anti-Corruption Commission or ACC. It also emphasizes the role of non-state institutions in participating self-regulation to gain public trust. Expectations from companies. The government expects companies to implement institution-specific strategies that align with the NIS, ensuring that the obligations of integrity permit all levels of the organization. This approach integrates various societal pillars to restore integrity within Bangladeshi society. Company-level integrity strategy. In line with the NIS, companies are encouraged to establish an ethics committee responsible for formulating and executing an action plan to promote integrity. The board of directors should oversee this committee, which is tasked with identifying achievements and barriers related to integrity, developing time-bound work plans to address these barriers, assigning responsibilities for implementation, monitoring progress, and reporting to the board. This initiative contributes to the broader goal of elimination of corruption and fostering a culture of integrity within the company and the society at large. Let us look at the ethics and compliance. Now, what is the meaning of ethics? Ethics involves the study of morality and the application of reasons to determine the right course of action. It relates to the standards of conduct and moral judgments that differentiate right from wrong, influenced by societal norms, values, and beliefs. Let us look at business ethics. Business ethics pertains to the application of ethical principles and methods of analysis to business situations, addressing moral challenges in areas such as finance, human resources, and marketing. Importance of business ethics. Business exists because of society, and ethical practices contribute to social welfare. Ethics are essential to people, fostering trust and cooperation. Ethical practices lead to positive social contributions and enhance the company's public image. Unethical practices can adversely affect all stakeholders, including the government and the environment. Ethical conduct cultivates strong teamwork and productivity among employees, leading to enhanced growth. Ethical dilemma. An ethical dilemma involves a situation requiring a choice between two or more morally acceptable course of actions, where selecting one may prevent choosing another. These dilemmas often present conflicts between moral imperatives, making the right decision challenging. Addressing ethical dilemmas. Resolving critical dilemmas require procedure and careful consideration, as decisions may impact the organization's profitability, competitiveness, and stakeholders. It involves evaluating the consequences of various options and choosing the course of action that aligns with the ethical principles. Code of ethics. Companies are encouraged to develop a code of ethics that reflects top management's commitment to compliance with values, rules, and policies supporting an ethical climate. The code should involve the chairman, the board of directors or BOD, the chief executive officer or CEO in its formulation and implementation, with legal staff ensuring it addresses key areas of risk. Now, what are the core values in a code of ethics? You see, a corporate code of ethics often includes 6 core values: trustworthiness, respect, responsibility, fairness, caring, and citizenship. Companies without a code of ethics must explain why they have not adopted one and may be required to provide a copy upon request. Role of the board in ethics and compliance. The board of directors plays a crucial role in upholding ethical values and compliance culture within the company. It is responsible for ensuring that ethical standards are integrated into all aspects of operations, preserving the interests of all stakeholders and promoting sustainable growth. Effective enforcement of ethical code requires a clear understanding and active observation by both the board and the management. Compliance. Compliance refers to conforming to specific rules, policies, standards, and guidelines. Regulatory compliance describes the goals that the company should aspire to achieve. Companies are required to remain committed to ensuring effective compliance with all regulatory requirements, which upholds their image and positions them as the responsible corporate citizens. Code of conduct. The Code of Conduct establishes principles for board of directors and its committees to uphold and promote the interests of the company. The board is responsible for setting the ethical tone and standards, while senior executives implement practices consistent with these standards. The code also complements the company's risk management practices. Now, what are the objectives? The objectives include, number 1, to protect the interests of the shareholders, customers, employees, stakeholders, then counterparts, and society at large. Number 2, to ensure integrity, high ethical standard, due skill, care, and diligence in all business activities. Number 3, to organize, manage, and control affairs responsibly with adequate risk management systems and financial resources. Number 4, to promote compliance with the code through resources, policies, procedures, process, systems, control checks, and training. And finally, number 5, to encourage rational behavior between shareholders and stakeholders, fair competition, and a stronger business environment. Now let us look at the regulatory compliance according to the Corporate Governance Code of 2018 in Bangladesh. The board, based on NRC recommendation, must establish a code of conduct for the chairperson, board member, and CEO. The code covers prudent conduct, confidentiality, conflict of interest, compliance with laws, prohibition for insider trading, relationships with employees, customers, suppliers, and independence. Now, what are the key areas of the code? Number one, business integrity. Business integrity includes issues such as conflict of interest, gifts and entertainment, bribery, compliance with laws, etc. Let us discuss them one by one. Conflict of interest, you see, like directors must act in the best interest of the company. We all know that by now. And they must avoid, you see, like competing against it, misusing positions or company information and benefiting improperly from inside information. Then gifts and entertainment. Directors must act honestly, responsibly, and fairly. They should not accept gifts or payments intended to influence business decisions. Bribery. Directors must uphold meritocracy and avoid giving or receiving bribes. Bribery is prohibited under Bangladesh law. Compliance with laws. Directors must comply with all applicable laws, acquire sufficient knowledge, avoid agreements with competitors that violate regulations, and are liable for violations. Another key area of the code is company assets and financial integrity. The code indicates that it is a responsibility to maintain accurate and complete data, records, reporting of accounting for the organization. Then, use of company assets must be done properly, and there has to be safeguard against loss, damage, misuse, or theft. Avoiding insider trading and market manipulation is obviously a must. Protection of confidentiality of all non-public information, including financial data, intellectual property, and strategic plans. Adherence to information security policies and relevant ICT laws are obviously mandatory. Compliance with anti-money laundering legislation and avoiding transactions with criminals, ensuring due diligence in selecting customers and counterparties are also essential. Then comes workplace integrity. The code also includes issues related to workplace integrity, such as equal opportunity and privacy and confidentiality. The code promotes meritocracy, dignity, respect, and equity for all members, regardless of race, gender, religion, age, or other personal attributes. The code also teaches to respect privacy and safeguard personal information, compliance with local and international data protection laws, collection of only the necessary information with consent, and using them for the intended purposes only, retaining it only as needed, and seeking legal guidance for sensitive data handling. So this code of conduct ensures ethical behavior, compliance with laws, integrity in all aspects of the company's operations, guiding directors in their responsibilities towards shareholders and the organization. Now let us discuss about the succession planning and capital planning. Succession planning is a strategy to identify and develop future leaders, ensuring continuity when directors resign, retire, or die. It balances institutional knowledge with fresh perspectives and provides guidance on identifying potential board members with key skills. Succession planning is ongoing, continuous. It involves assessment and development of people to maintain the board's effectiveness. Boards should ensure the right skills, talents, and attributes are represented. Now, the key practices of succession planning include creating a second line of management to reduce dependence on a single individual and to promote group dynamics. Using a skills matrix to shape board composition, considering strategy, industry developments, and challenges. Conducting annual performance evaluations, preferably facilitated by independent third parties. Establishing written director qualification standards aligned with business strategy. reviewing evolving committee and board leadership needs, including time commitments, considering director election results and investor engagement regarding board composition, independence, leadership, and diversity, promoting an independent mindset and board diversity to enhance debate, oversight, and strategy development, providing mentoring and development opportunities for incoming directors. Now let us discuss about capital planning. Capital planning is critical for company sustainability, profitability, and growth, impacting the shareholder and stakeholder value. It involves analyzing current and future capital needs relative to strategic objectives, including anticipated expenditures or forecasted expenditure, desired capital levels, and external funding sources. Effective capital planning ensures adequacy even during economic downturns. Key considerations include assessing the current capital requirements and sustainable capital levels aligned with the strategy and risk profile, identifying internal and external resources to increase capital, evaluating financial leverage, cost of capital, and tax implications of present and prospective projects, monitoring risk arising from financial management and profit-generating capability, preparing a 3 to 5 year capital plan, revising at least every 3 years as necessary. Now, board responsibilities include defining capital planning goals to balance shareholder returns with protection of investors, creditors, and suppliers, integrating capital planning into the strategic plan to avoid jeopardizing objectives, conducting annual strategic planning over a 3-year horizon, forecasting key economic variables, and assessing financial impact of initiatives, reviewing capital ratios, targets, and levels against the company's risk profile, analyzing present and future capital needs, and adopting suitable capital raising methods, ensuring capital management aligns with the risk profile and the business environment, and finally, setting capital targets for short, medium, and long term, identifying issuance requirements, timing, and market execution under varying conditions. Related party transaction. A related party transaction refers to any transaction, arrangement, or relationship in which the company or its subsidiaries participate and a related party has a direct or indirect interest. Such transactions may create actual or potential conflicts of interest and could be misaligned with the company's and shareholders' best interests, particularly affecting the minority shareholders. Related party transactions can sometimes serve legitimate commercial purposes, such as exchange of goods or services at arm's length. Identification of related parties. A person or close family member is related if they control, jointly control, have significant influence, or are key management personnel of the reporting entity. An entity is related if it belongs to the same group as or is an associate or joint venture, provides key management services, or has a relationship as specified under IAS 24. Types of related party transactions. Financial assistance via loans, guarantees, and collateral, asset sales and purchases, sale, purchase, or supply of goods and services in the ordinary course of business operations, bailouts, transfers of property, services, research, licenses, or finance agreements. Approval process. Directors must disclose, remember, they must disclose any interest in a related party transaction under Section 130, subsection 1 of the Companies Act 1994. Interested directors cannot vote on related transactions as per Section 131. Certain contracts require directors' consent as per Section 105, and restrictions exist on directors' power as per Section 107. Material related party transactions require shareholders' approval, with interested directors excluded from voting. Disclosure requirements. Relationships between parents and subsidiaries must be disclosed regardless of transactions. Related party relationships should be disclosed whenever control exists. Key management personnel Compensation should be disclosed in total and by category. By category means short-term, post-employment, long-term, termination, share-based payments, etc. Information on related parties, outstanding balances, terms, guarantees, provisions for doubtful debts, and related expenses must be disclosed to enable users of financial statements to assess the effects on the entity. Website management and governance of subsidiary companies. Public listed companies must maintain an official website linked to the stock exchange, functional from the date of listing, to provide information to the shareholders, investors, and regulatory authorities in compliance with the Corporate Governance Code 2018. Condition number 8. The website should disclose details of the business and legal status, information about subsidiary companies, profiles of chairman, directors, MD and senior management, composition of the board and its committees, CSR activities in terms of appointment of independent directors and board code of conduct, whistleblower policy and related party transactions, contract details for investor grievance redressal, complete financial information including annual reports, balance sheet, profit and loss account, and corporate governance report, shareholding pattern, price-sensitive information, agreements with companies, associates, credit ratings, and audited financial statements of each subsidiary. Governance of the board of directors of the subsidiary company. The holding company must ensure governance of its subsidiary company as the subsidiary's performance affects the holding company's financial statements and shareholder earnings. Compliance with Corporate Governance Code 2018, condition number 2 includes applying holding company board composition rules to the subsidiary board. At least one independent director from the holding company serving on the subsidiary board, reviewing minutes of subsidiary board meetings in the subsequent holding company board meeting, noting in holding company board minutes that subsidiary affairs have been reviewed, audit committee of the holding company reviewing the subsidiary's financial statements, especially investments made by the subsidiary. Committees of the Board of Directors. Committees of the Board of Directors, or BODs, are small groups formed with board members to support the board's work, especially in areas requiring expertise, focused discussion, and technical evaluation. They improve board effectiveness, enable better management of the board time, prepare groundwork for decision-making, and strengthen governance by allowing in-depth scrutiny. Now, what is the need and rationale for it? Committees are necessary due to increasing business complexities and time commitments of directors. As per Companies Act 1994, boards can delegate powers to committees or require recommendations for approval. If we list the needs and rationale, then we will see that strengthening governance and support strategic objectives, enhance strategic decision-making and non-executive director input, maximize the contributions of non-executive directors, providing clear goals, objectives, and terms of reference to function efficiently will certainly fall among the needs and rationale of, let's say, the board committees. Now, question is, what are the board committees? What are the types of the board committees and what are their roles? We'll discuss about them one by one. First of all, Executive Committee. Executive Committee handles urgent and routine matters between board meetings. Members are nominated from the board based on integrity, dedication, and capability. Executive Committee can act on delegated powers or as instructed by the board. Decisions must be ratified at the next board meeting, and meetings require pre-distributed detailed memoranda, and decisions are recorded in the minutes. Now let us look at the Audit Committee. The Audit Committee assists the board in ensuring true and fair financial statements and good monitoring systems. It is composed of at least 3 non-executive directors, including 1 independent director. Members must be financially literate, with at least 1 having accounting or financial management expertise. Chairperson must be an independent director, attends annual general meeting, or appoints a member if absent. Conducts at least 4 meetings per year, emergency meetings possible. Roles include overseeing financial reporting, accounting policies, internal audit, compliance, external auditors, related party transactions, and IPO or repeat public offering or RPO proceeds usage. Reports to the board immediately on conflicts of interest, fraud, legal infringements, or other critical issues. Can escalate unaddressed issues to the Commission after repeated board reporting. Reports to shareholders via annual report signed by the chairperson. Nomination and Remuneration Committee, NRC. NRC assists the board in formulating nomination criteria, qualifications, independence of directors, top-level executive appointments, and remuneration policies. It is composed of at least 3 non-executive directors, including an independent director, members appointed or removed by the board. Chairperson attends the annual general meeting or appoints another member if absent. Conducts at least 1 meeting per year. Emergency meetings can be convened, obviously. Roles include setting remuneration policies, board diversity, performance evaluation, employee selection, transfer, promotion criteria, and reviewing HR and/or training policies. NRC's nomination and remuneration policy, evaluation criteria, and activities are disclosed in the annual report. Relations with shareholders, that is members and institutional investors. Effective communication with stakeholders, with shareholders, institutional investors, and key stakeholders is vital for implementing sound corporate governance. Key roles such as chairman, managing director or CEO, and company secretary play a crucial role in maintaining good relationships that ensure the company's well-being. Concepts of majority and minority. Majority shareholders hold or control more than 50% of shares, giving them absolute control over company operations, particularly board selection. Minority shareholders hold less than 50% of the shares and may be unaware of their rights or unable to participate effectively in meetings. Small shareholders often avoid participation due to travel cost, short-term investment horizons, or believe that their vote does not matter. Majority shareholders may favor investing in risky ventures, whereas minority shareholders may prefer dividends. A balance of rights ensures efficient company functioning. Concept of minority rule and minority interest. Companies function through the board, guided by the majority while considering overall company welfare. The rule of majority established in Foss versus Harberton in 1843 allows majority decisions to control company affairs with exceptions for breaches, fraud, oppression, or inadequate notice. Equitable treatment of shareholders. Companies should secure shareholder rights and ensure equal treatment, particularly for minority and foreign shareholders. How can they do it? You see, they can do it through different measures. These measures can include equal treatment for all shareholders of the same class, facilitating participation in key governance decisions, including the board nomination and elections, enabling voting rights for foreign shareholders, preventing insider trading and abusive self-dealing, ensuring accessible and cost-effective general meeting procedures. Protection of minority interest. Minority shareholders have rights to profits, company information, and participation in meetings. Companies Act 1994 measures include mismanagement investigations under Section 195, protection against oppression by majority shareholders under Section 233. Courts can cancel or modify resolutions, regulate company affairs, and amend memoranda or articles to protect minority interest. Corporate Governance Code 2018 requires directors to state that minority shareholders are protected from abusive actions. Now, what are the rights and powers of shareholders? Shareholders, as company owners, exercise rights from membership until cessation. Key rights include receiving share certificates and transferring shares, registration as member and receiving meeting notices, attending, speaking, voting, appointing proxies and amending polls at general meetings, accessing company documents, dividends and statutory reports, applying to court for mismanagement, minority protection or company winding up. Directors report to the shareholder. The board must provide information per Companies Act 1994 and Corporate Governance Code 2018 to ensure governance and communication. Now, the directors' report to the shareholders should include the state of the company affairs, reserves, dividend proposals, and material changes, changes in business nature, subsidiaries or business classes, explanations for auditors' remarks, industry outlook, segment-wise performance, risks, cost and profit analysis, extraordinary activities, related party transactions, proceeds utilization, variance explanation, director remuneration, assurance of financial statements, internal control, minority protection, going concern statement, operating or financial data for 5 years, dividend explanations, board meetings and attendance, shareholding patterns. Director appointment details, managing discussion and analysis, CEO or CFO declarations, and compliance certificates. Role of institutional investors. Institutional investors manage funds on behalf of clients and influence corporate governance. Governance-sensitive investors prefer companies with existing governance mechanisms, reducing monitoring costs. Tools for assessment include one-to-one meetings with the large investors, voting on resolutions directly or via proxy, focus lists to target underperforming companies, corporate governance rating system as for example Demeanor, S&P or GMI. Institutional investors could disclose corporate governance and voting policies. Then UK Stewardship Code 2020, which includes establishing the principles for long-term value creation, effective stewardship, and responsible capital allocation. Then 12 principles for asset managers, owners, and 6 principles for service providers. Now, companies should prepare materials addressing shareholders' votes and major issues, meet and communicate with proxy services firms before and after the recommendations, monitor proxy services for accuracy, encourage direct year-round engagement with institutional investors, maintain trust, and correct erroneous or outdated information affecting shareholders' interest. With this, we close the discussion for this particular topic. Thank you.